Good morning and welcome to Charting the Markets on Tuesday, the 10th of October. Federal Reserve Chair Philip Jefferson and Dallas Fed President Lori Logan both cited the backing up of long-end Treasury yields, potentially doing the desired tightening that the Fed has been trying to achieve. And on that news, US equity markets rallied at the end of the session yesterday. And this also led to Asian markets ending up the session today in the green for once. And you can see that here on the Nikkei 225 daily financial bet. And here we see that we are in the process of trying to break through the September to October downtrend line, which currently can be seen around 31,770. And the next upside target really is the orange line here. If we were to break through that downtrend line, that is to say, and close above it on a daily chart closing basis today. And that orange line is the 55-day simple moving average at 32,247. And we also have in sight the early October high at 32,410. Now, since that is the last reaction high, that is to say a high which is higher on the daily candlestick than the one to its left and to its right, this is the last level from a technical perspective that needs to be overcome for us to form a bottoming formation and for us to confirm the break of the downtrend. And if that were to happen, the Nikkei 225 could actually rally back into the highs seen since June of this year. So basically between the 33,500 and 34,000 area. So that is a distinct possibility, especially now at the beginning of October, where traditionally since the Second World War, equity markets tend to have a positive seasonality in their favor towards the end of the year. So basically watch this space, and from a technical perspective, we need to see a break today, ideally, or tomorrow above the downtrend line, and then over the next few days, a rise above the early October high at 32,410 for us to form a bottom. Now, support can be seen at yesterday's low at 30,930, provided we stay above there, and the red line here, the 200-day simple moving average at 30,786. My bullish scenario here from a technical perspective will remain intact. Now, if you look at the UK market, the FTSE 100 has benefited from the rising oil price. Yesterday, we had a rise of about 3.5% in the price of oil due to heightened tensions between the Gaza Strip and Israel. And here you can see the acceleration to the upside on the back of these stronger Asian markets here, also pushing European markets such as the FTSE 100 higher. And as we can see here, we are now getting closer and closer to the 200-day simple moving average here in red at 7,650, and also the last reaction high, that is to say, the late September high at 7,675. So here, from a technical perspective, we need to close above 7,675 for us to form a bottom. That would mean that this is just here, that corrective move, an ABC Elliott wave correction, and that the uptrend should continue. And that would also mean that we will reintegrate this previous sideways trading range with these highs going back to July and September of this year between 7,723 and 7,747, and could then perhaps head back up again towards the highs seen back at the end of April at 7,938. So the FTSE 100 is also looking quite positive, as we can see here in the short term. Now, moving on to American markets, we can see the Dow Jones Industrial Average having retested on Friday its previous low during the week, which was a low which basically took us back to levels last traded at the beginning of June at 32,813. Well, that retest was successful, and since then we've had we're on track for our third consecutive day of gains, and also are heading towards the 200-day simple moving average here in red at 33,837. And here the last reaction high was the late September high at 33,900. And if we were to manage to close above there, then for me, technically, that would mean that a reversal to the upside is probably taking shape, and that we've seen an A, B, C zigzag Elliott wave correction from the high back in August, which would mean that further upside could take us above that high in the weeks and months ahead until the end of the year. And I'm quite confident with this view because we've had this retest of this key support. The low we made in October is also very close to the low we made in May. And this could be just a corrective move within a longer term uptrend, as we can see here. And that would then mean that the Dow Jones Industrial Average could actually head all the way back up again towards 36,000 or so. But we would have to stay on a daily chart closing basis above 30,813 on this daily financial bed. That is to say the early October low for this view to remain valid. Moving on to the Nasdaq 100, the great outperformer, as you can see here in the US, having risen by the most compared to all the other US indices since the beginning of the year. Here again, we could see an ABC correction, which was actually not as extreme as seen on the other markets, such as the Dow Jones Industrial Average, in that we actually managed to hold in September and in October around the August lows. And here we also formed a bottom already, technically speaking, because we've taken out the last reaction high. So we've got this W formation, and that means, from a technical perspective, that provided we stay above 14,430, the late September low, we should have an upside target of the distance between that low and the high here seen around 14,900. So we're talking about 470 points higher from there, and that would take us back up towards 15,300 or so over the next few days. And then above there, we've also got the July to October downtrend line, which can currently be seen around 15,360. So these are the upside targets for the Nasdaq 100 as well. Last week, the US dollar basket didn't manage to close for a 12th consecutive week in positive territory. Instead, it did consolidate slightly. And this US dollar consolidation happened also yesterday as US yields started to come off their lofty heights of the last few days. And that was on the back of dovish comments by Fed members yesterday, saying that a lot of the work which the Fed is trying to achieve with its tightening is now taking place because of those higher US yields. And therefore, we may no longer see a rate hike in the US in November of this year, which has led to risk-on sentiment and to the US dollar slightly depreciating. And that has benefited currencies such as the British pound. As you can see here, the British pound is now on track for its 5th consecutive day of gains versus the US dollar, having made a low at 120.38 last week, which was a level last traded at in the middle of March of this year. And what is interesting from a technical perspective is that now that we are approaching the last reaction high, that's to say the late September high at 122.71, it becomes interesting because basically if we were to close above there today, 122.71 or above, from a technical perspective, we will have formed a reversal. And in that case, we could be heading not only just up to the July to October downtrend line, which currently can be seen around 123.92, but also towards the 200-day simple moving average here in red at 124.41, and probably also all the way back up to the late June lows and mid-August lows between 125.91 and 126.17. So from a technical perspective, it'll be very interesting to see whether this week we can rise above this late September high at 122.71, and if so, the odds are stacked in the favor of the bulls with regards to cable once more. If you look at the euro versus the British pound, you can see here that the British pound is also appreciating because we have basically tested yesterday the late September low at 86.31, have held there and are bouncing off that level at the moment. But if we were to fall through it, we would likely be heading down towards the orange line here, the 55-day simple moving average at 86.06, and reintegrate the middle of this June to October sideways trading range we've been in over the last few months. But the fact that we've broken through this minor uptrend line does indicate to me that the odds are now pointing towards further slides likely to be seen, provided we stay below the last reaction high, that is to say the early October high at 86.91. Now, in Australia, what we saw is the Australian dollar also bouncing back against the US dollar. As we can see here, there we are also on track for a 5th consecutive day of gains, as Australian business mood remained unchanged for a 3rd month in a row, and consumer mood improved in October. And here we're approaching the July to October downtrend line at 64.52, and also the orange line, the 55-day simple moving average at 64.60. So these are the minor upside targets. And then we've got some really important resistance between the last reaction high, which was made at the end of September at 65, but also because we have previous monthly highs, the late August and also September high between 65.11 and 22, because they're quite close to that 65 level from the end of September. I would consider all of that as a major resistance area. So basically what I'm saying is we need to rise above this whole 65 to 65.22 resistance area for a bottom to be formed with regards to the Australian dollar versus the US dollar. And if that were to happen, then we could head all the way back up towards the 200-day simple moving average here in red at 66.76. So short term, where's resistance? Where we've got the downtrend, as I said, and the orange line, the 55-day simple moving average, but also the late May low at 64.59, which may cap in the short term. The consolidating US dollar has given some commodities an boost, but more importantly, especially with regards to the price of oil, the tensions and the heightened tensions in Israel and in the Gaza Strip have led to a surge in the oil price by about 3.5% yesterday. And we can see that here on the daily Brent crude oil chart. And that basically created this price gap that we've seen between yesterday's low at $85.89 and Friday's high at $84.53. That gap is still open right now. We're just trading sideways below the orange line, the 55-day simply moving average at $87.72, which acts as resistance. And we'll have to see whether we can close at least partially this price gap in the days to come. Now, that is a possibility, and likely provided we stay below the breached June to October uptrend line, which now, because of inverse polarity, because we've fallen through it, has become a resistance line, and that currently comes in around $89.64. Provided we stay below there, the odds would indicate that the descent we've seen over the last few weeks is likely to resume at some stage and close this gap. And if that were to happen, it's very likely that we would also then fall back down to the August low at $81.68, and also the 200-day simply moving average here slightly higher at $81.92. So short-term, we're just consolidating, or very much depend on whether the conflict in Israel will widen and whether Iran and the United States might get involved or not. If that were to happen, then the oil price would probably rally very quickly and also rise above the psychological $90 mark. But that is all just speculation. So for the time being, we're just looking at the chart, and what the chart is telling us is that as long as that breached previous uptrend line, now a resistance line, caps, further downside looks to be more likely than any upside in the short term. Now, the gold price also rallied with regards to the Israel situation at the moment. And you can see here that we rallied earlier this morning to $1,865 per troy ounce, and are slightly coming off that. Now here we also have a price gap in place between Friday's high and Monday's low. Monday's low was made at $1,845 and Friday's high was made at $1,811. That price gap may be closed in the days ahead if tensions in the Middle East were to diminish over the coming days, which is unlikely to happen, to be honest. So if we were to continue to rally, well, technically speaking, we've got some pretty good resistance between the August and also the June lows between $1,885 per troy ounce and $1,893, which should probably cap any upside in the short term. And last but not least, I'd like to talk about natural gas, because if you look at US natural gas futures, these are now trading at 9 to 10 month highs. If you go onto the daily chart, you can see here that the last time we traded at around the $3.50 mark, that was in the middle of January of this year. And it means that we've broken out of this long bottoming formation here, which has taken several months to form. And the rise in the gas price from a fundamental point of view is occurring as weather forecasts are predicting much colder weather going forward, and gas suppliers are therefore expecting to see a surge in demand, which has now also led to the surge here in the price of natural gas. That rise is currently losing upside momentum, which could potentially mean that over the next few days we might come off again. But right now it's too early to say. If we were to rise above $3.58.5, that is to say yesterday's high, the next technical upside target would be the mid or the 12th of January high of this year at $3.74.20. So that would be the next upside target, and perhaps then the $3.80 mark. But if we were to come off, well, there isn't really any support to speak of until we get back down again towards the March and also the August highs between 305.6 and 305 with regards to $305 with regards to US natural gas futures. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X, formerly known as Twitter. My handle is at AxelR_IG. With you now. Okay. Don't worry, I'll just do one that doesn't cost me much time to do it. So let's just say I'll do the Dow Jones